Hi, welcome back to this course on infrastructure finance. So far we have looked at how do we actually use information in the company's balance sheet and try and analyze the firm's performance. Now we will move further on and then we will talk about essentially how do we analyze a project's viability. Remember, this course is all about infrastructure finance, and we are really looking at how do we actually make a decision in terms of financing a particular infrastructure project. So an important decision in the whole process is to identify project viability. So that is what we are going to spend some time on for the next few sessions. But before we actually do that, we will try and discuss the thought question that we put forward in the previous lecture. So in the last lecture we ended up with a question: what are the limitations of using the ratio analysis in analyzing the performance of a company? No doubt ratio analysis is a very important part in analyzing the company's performance, and we can use the information available in the balance sheet and the profit and loss account to analyze performance across various parameters. It could be in terms of the growth, it could be liquidity, it could be leverage, it could be efficiency, which largely includes the turnover ratios. It can also in terms about profitability, it can also in terms of the company's valuation. But when we are trying to use this ratio analysis, it is very important for us to understand that we also see some logic behind these numbers. We should not use it as what is called as a cookie cutter method and trying to blindly take the numbers from the financial statements and try to come out with the different ratios. If we try and do that, we may not be able to get or do correct interpretations. Let us take an example. For example, if you look at the case of the healthcare sector, it is very normal for a doctor to actually prescribe some laboratory tests, and it is always indicated in the test results that the test results should actually be correlated with the clinical findings. So that is the results of the test should be seen vis-a-vis the symptoms that doctor sees in a clinical examination. Similarly, when we look at the ratio analysis, it is also very important to understand what is the underlying rationale as to why the numbers are behaving in a way that we see in our analysis. Let us take a simple example. Let us assume for a particular year the return on equity is dramatically lesser. So what could be the reasons the return on equity can be dramatically lower for a particular year? If you simply compare the return on equity on two particular years, and if you find that return on equity is lower in the recent year, that does not necessarily mean that the company's performance has been really bad. It could be because of the other reasons, that is why the return on equity has been lower. Now what could be the other reasons? Let us first look at what is return on equity. Return on equity, if we have to really look at the expression, it goes something like this. Return on equity is nothing but your profit after tax divided by your total net worth. Now return on equity can reduce because of two reasons. One is the profit after tax can reduce, or second, the net worth can have a very high increase but not matched by a corresponding increase in a profit after tax. Now let us look at the second case. In the second case, the net worth has dramatically increased and the profit after tax has not increased in a corresponding manner. What could be the reasons behind it? The reasons could be the company has actually implementing a very large project, and because of that it has taken a substantial additional investment in terms of equity, and since in the infrastructure project it takes a fairly long time for the project to come into operation. That means there is a lot of gestation time, and only when the project gets into operation there will be a corresponding increase in the profit after tax. Only when the company starts getting revenues, the revenues will lead to profits, and that will get reflected in your profit and loss account. Now if you are looking at calculating the return on equity on a particular year where the investment has actually happened in terms of equity, but the project has not come into operation, and therefore there has not been a corresponding increase in profit after tax. Now when we look at that kind of a situation, you will actually find a return on equity to be lower for a particular year in which the company has taken substantial amount of investment. Now that does not necessarily mean to indicate the company is not performing well, it just part of a regular business cycle. So we have to really understand the reasons why the return on equity has actually reduced for a particular year, rather than simply saying that the company's performance has been bad. Similarly, if you look at another reason why the ROE could be lower, the ROE could be lower because let us say the profit after tax can be lower for a particular year. Now the reduction in profit and after tax can also be attributed to various reasons, many of which could be, let us say, beyond the company's control. It could be, for example, because of sudden reduction in the market price for the products and the services that the company is producing, and so on. So we also have to really understand the reasons behind the reduction in ROE without simply attributing it to the poor performance of the company. And if this reason seems sufficiently valid, then we will have to wait and watch how the company is able to come back to its original performance metrics after the gestation period is over. So similarly, for each and every ratio we can identify the various reasons that could actually affect the company's performance measure, and we will have to be cognizant of these reasons when we are actually also doing the ratio analysis. Now let us go back to the topic of the day, which is to talk about project viability, and in this session we will talk about the time value of money. So project viability broadly can be looked at it from two perspectives. One is the technical viability and the second is the economic or financial viability. So technical viability is largely dependent on the technical features of the project. So essentially we are trying to see, is the technology available today adequate for us to be able to complete the project as per what we have budgeted for. So do we really have the technical know-how, do we really have the project management skills, do we really have the construction methodology properly developed to ensure that the project would be developed, project would be constructed as per what we have planned. So in many cases for routine projects technical viability is not really a major issue. For example, if you are constructing a road on a regular terrain, today we have many years of experience of constructing roads, so it is not going to be a major question mark on technical viability. But let us say, for example, we are constructing a difficult project that involves constructing a bridge over a water surface, or it involves constructing tunnels in a mountainous area, or it involves constructing roads over a very difficult terrain. Then if it is of first of its kind, then there has to be a lot of background studies that needs to be undertaken before we can actually determine that whether it is technically feasible to actually develop the project, whether do we actually have the adequate wherewithal or the engineering skills to develop the project. The next dimension of viability is your economic or financial viability. So economic or financial viability simply means that does the project give adequate returns so that we are able to recover the costs. So is the project financially viable so that the investor is able to recover his capital and also get an adequate return on the capital that he has invested. So that is the dimension of the economic or financial viability. Now in this course on infrastructure finance, we are going to be primarily concerned about the economic or financial viability. We assume that the technical viability is given. In fact, if you look at as a sequence, the first measure of project viability is always the technical viability. Only when the project passes the technical viability test do we actually perform what is called as economic or the financial viability. Since we are really going to focus about the economic or the financial viability, let us assume that the technical viability is given. So that means the tests have already been conducted and the project has passed the viability or the technical viability test. So there are several projects which can be technically constructed, but it may not be commercially viable for a variety of reasons. Now we have to really determine technical viability does not mean that it is also automatically economically viable. So, we will have to separately conduct tests to determine the economic or the financial viability of the project. Now, in a very broad sense, what do we actually mean by viability, and when we say a project is viable, what do we actually mean by that? So, when we say project is viable, we are simply indicating that the benefits that we actually get from the project is more than the costs that are incurred in developing the project. So, that is a simple, very simple expression to determine the project viability. If the benefits are lesser than the cost, so that means the project is not financially viable. If the benefits are more than the cost, then the project is financially viable. Now, in a more accurate sense, we also have to talk about, we do not really have one benefit or two benefit, essentially we are talking about a summation of benefits. So, if you are talking about summation of all the benefits is greater than the summation of all the costs that are incurred, then the project is considered to be viable. So, the next question is, we have to identify the different benefit and costs, and after having identified the different benefit and costs, how do we actually measure the benefits and costs? Now, we also have to understand that this course is all about infrastructure finance, and essentially how do we actually measure the benefits in terms of financial, in terms of something that can be used in the world of finance. So, if you really talk about benefits or costs in the world of finance, the common denominator in which you are going to measure anything is in terms of what is called as a cash flow. So, benefits we measure in terms of the cash flows, the costs we measure in terms of cash flows. So, what are benefits? So, benefits are essentially, if you look at it from a cash flow perspective, the benefits are the profits that are earned by the project. Now, there are different ways in which you can look at benefits. Benefits can also be looked at in a very broader perspective, let us say from a social angle. Social benefits can not necessarily only mean in terms of profits, but also it could be in terms of the welfare that it provides to the society as a whole. But let us not really talk about social welfare in this course. We are really talking about economic viability, and therefore, if we look at economic viability, it is simply the profits that the project is able to generate for its investors. And what are costs? Seen in the same perspective, costs are nothing but the investment that is needed to have the assets in place. So, essentially investment that is needed to have the project developed. So, that could be in terms of construction costs, that could be in terms of land acquisition costs, it could be the investment needed for various machinery, equipment, and so on and so forth. So, ultimately we will have to identify the various benefits, sum it up, identify the various costs, sum it up, and net of this will actually determine whether the project is viable or not. Okay, before we actually look into how do we sum up the various benefits or how do we sum up the various costs, we need to understand a very important aspect in the world of finance, which is your time value of money. I will start with a simple question: what is the main characteristic of infrastructure projects? There are several characteristics, but for the topic that we are going to discuss today, the main characteristic that we should be aware of is the fact that infrastructure projects have a very long life, and the second important characteristic is there is a very long gestation period. So, there are two important things. It has a very long life. So, when you are talking about long life, that essentially means that the benefits that we are going to get from the project is going to come for a very long duration. So, normally we are talking about infrastructure projects having, let us say, tens of years of a lifetime. So, if you are looking at a bridge can have a lifetime anything between 20 to 30 years, and if you are talking about the license that are normally given to the infrastructure operators, the life of the license varies anything between 30 to 60 years. So, for as long as the license is valid, the infrastructure developer will have access to the profits from the particular project. So, therefore, the life of an infrastructure project is going to be fairly long, and therefore, the benefits are also going to accrue for a fairly longer time frame. and the second is the gestation of the project is also relatively longer. So it takes many years before the project comes into operation. So that means all the investment that is needed for developing of the project, it takes place over many years. So development of a power project might take 2 years, construction of a very complicated bridge might take 3 to 4 years, and an airport project might take about 2 to 3 years, and so on. So the investment is again spread over many years. So therefore we will have to really consider the fact that there is a time aspect associated with which these benefits as well as costs are incurred. So now what is this time aspect of money? So let's start with a very simple example. Let's say your friend owes you 100 rupees, and he gives you two options. Option number one is he will give you 100 rupees today, and the option number two is he will give you 100 rupees 1 year from now. Now among these two options, which of those would you actually choose, and why? Now if a rational human being would normally choose the first option, whereby you would prefer to get 100 rupees today rather than wait to get the same amount of money 1 year from now. Why? Because of the simple reason, the fact that in English we normally have a very proverb which says that a bird in the hand is worth two in the bush. So that means anything that you get today is more valuable than what you might actually get sometime in the future, simply because of the fact that the person who has promised you to give something today might actually go back on his promise with time. So therefore you would prefer to actually get what is available today rather than wait for it to be coming to you in the future. That is one. The second aspect is the fact that what you have today, it can actually be more valuable in the future. Let's talk about that now. Let's say you get 100 rupees today, that can actually be invested in a bank at an interest rate of 10%, and therefore the total value of the investment at the end of 1 year will be your original amount that you have invested plus the interest that the investment earns when you actually make the deposit in the bank. So therefore the total value of rupees 100 that you deposit today would actually be worth 110 1 year from now. So therefore from a purely time perspective, you are able to get an additional return if you are able to get 100 today over a period of 1 year. So therefore if your friend promises 100 today or 100 1 year from now, then you are most likely to choose 100 today. Simple reason that the time value of money makes 100 more valuable 1 year from now as compared to what it is today. So on the other hand, if your friend promises 110 1 year from now and 100 today, so both of them are equal, because you are going to get 110 if you deposit this rupees 100 in a bank at the rate of 10% interest. Now by the same token, let us assume that you are going to deposit 100 now, and at the end of 2 years the value of 100 rupees is going to be 121, because you are going to get interest for 2 years at the rate of 10% per year. So if you use the same approach, the present value of 100 that you are going to get 1 year from now is going to be 100 divided by 1.1, that is 90.91. So in essence what we are trying to say is the value of 100 1 year from now is actually going to be in present terms only 9.91. So this essentially is what is called as your time value of money. So let us quickly sum it up. Let us say when you are talking about the present value, we are talking about the value today, we are talking about value time is equal to 0, and then you have what is called as your future value. So future value could be at any particular time, future value could be at time t is equal to 1 or 2 and so on. Now what is the relationship between the present value and the future value? So future value is nothing but present value multiplied by 1 plus I, which is your interest rate. Now future value at the end of year 1 is nothing but the present value multiplied by 1 plus I raised to the power of 1. Future value in year 2 is nothing but present value multiplied by 1 plus I raised to the power of 2. And then if you go by the same trend, future value at the end of year n is nothing but present value end of n multiplied by 1 plus I raised to the power of n. So if you get 100 1 year from now, 100 1 year from now, that is your future value is going to be 100. So the present value of that is nothing but divided by 1.1, since 10% is your interest rate. So I am sorry, I think you will have to stop here for a minute. So present value is nothing but 100 divided by your 1.1, and this is going to be 90.91. So if you are an investor, you are indifferent between getting 90.91 today or getting 100 1 year from now. So the value of 100 is not the same today as what you are going to get 1 year from now. So this is your present value of money concept. Now when you are going to add the benefits over a period of time, we cannot directly add the benefits that are going to occur for many years in the future, because they are simply not equal. As we just seen that 100 today is not equal to 100 1 year from now. The benefits occurring in different years is not considered to be equal. So we can add in the world of max only if they have an equal attribute. So in essence, when we can really add, what we mean that we can only add when they are brought down to the present value. So let us take a simple case. So let us assume that a project has the following cash flows, and in year 1 the project gets a cash flow of 100, in year 2 it is 200, and in year 3 it is 300. So now we will have to calculate the sum of all the benefits, and we cannot directly add 100 plus 200 plus 300 simply because they are occurring at different periods in time, and because they are occurring in different periods of time, the present value of each of these benefits is going to be different. So therefore they would have to be brought down to the present, they would have to be discounted to time 0 before we can actually add them up to find out what is the total sum of benefits. So let us now discount all of them to the present. So 100 1 year from now, if it is discounted to the present, it will give a value of 100 divided by 1.1. 200 when it is discounted to the present, since it is a cash flow stream that is coming 2 years from now, the present value of that is nothing but 200 divided by 1.1 whole square. 300 occurs 3 years from now, and if you discount it to the present, it is nothing but 300 divided by 1.1 to the power of 3. So now we can calculate the values of each of those. So this is nothing but 90.9, and 200 by 1.1 whole square is nothing but 165.2, and 300 divided by 1.1 raised to the power of 3 is nothing but 225. So now all of them can be summed up because they are all in present value terms, and therefore when you actually sum it up, the total value of all these benefits turns out to be 481.4. So the summation of benefits for a project of this type is 481.4. On the other hand, if you are able to directly add the cash flows, then we will get a figure of 600, which is not correct because we are talking about benefits occurring over many periods and this cannot be directly added up. Now if the project is considered to be viable, so that means the summation of the costs that are needed for developing this project should be lesser than 481.4. If it is lesser than 481.4, then it is considered to be viable. Okay, now they are looking at a very generic expression of calculating the present value. So let us assume that the project has a life of many years. Let us say it has a life of n years, and each year the project makes, let us say, a profit of equal amount, which we call it as A. Now the present value of these benefits needs to be calculated. So the present value of this cash flow stream is nothing but A. If you assume that the rate of interest is I, it is going to be A divided by 1 plus I, A divided by 1 plus I whole square, so on, it will give by A divided by 1 plus I to the power of n. Now if you look at it, this summation is a simple geometric progression, and we can use the expression to calculate a sum of a geometric progression to determine the value of this expression. So this is nothing but a geometric progression with an initial term A is equal to A by 1 plus I, and the difference between two ratios is nothing but 1 by 1 plus I. Now the summation of this is nothing but A 1 minus 1 plus I raised to the power of n divided by I. Now one thing that we need to remember in this expression is that we are talking about cash flows or the profits being equal in each of the years. When we have this kind of a situation, we can use this expression to calculate the present value, but if we have cash flows that are varying with each and every year, then we will have to discount each of these cash flows manually to the present and then sum it up. In fact, the previous example that we saw where we had unequal cash flows in each of the years, and when we have these unequal cash flows, then we will have to be discounting discounting each of the cash flows to the present and then adding it up. But if we have equal cash flows, then we can use this expression to calculate the present value. Now in real life there are several projects which more or less have equal cash flows, and when we have this kind of cash flows, they are called as annuities. Annuities essentially mean that we have equal cash flows occurring over regular periods. So the periods are regular between two cash flows, and when we have this kind of a situation, we can use this expression to calculate the present value. So one of the simple applications of time value of money is what is called as the loan amortization. What is a loan amortization? When we actually take a loan and when these loans are paid in equal periodic installments, this is called as a loan amortization. So let us again take an example of a loan amortization to see how we are actually going to use the present value of money concept. Let us assume that we are taking a loan of 100,000 and these have to be paid back in 5 equal installments. It could be over 5 years, it could be over 5 months, whatever the case may be, but 5 equal installments, and the installments are occurring at regular periods. And then the rate of interest is 15%. So the question here is, what should be each installment? What will be the value of each installment? So simply taking, we are trying to find out the value of every installment whose present value is 100,000. Okay. So if we kind of put it in a year wise format, so the present value that we have is 100,000. So we have actually taken a loan of 100,000. So this is the present value of the loan that we have today, and this present value is equal to an equal amount A that we will have to pay over 5 periods, and in this case it is assumed it's 5 years at an interest rate of 15% per year. So what is actually A? So if we use the expression that we derived previously to calculate the value of A, so that means 100,000 is equal to A multiplied by 1 minus 1.15 raised to the power of 5 divided by 0.15. So with this we can get the value of A to be 29831. So if you need to repay the loan of 100,000 in 5 installments, that means each and every installment would be valued at 29,831. So that is the first part. Now how can we actually use this information to determine some of the other aspects? So we can use this information to construct what is known as your amortization table. So we will construct what is called as an amortization table, which will be something like this. Okay, if you look at in year 1, we are starting with a loan of 100,000. So that is your beginning loan, and in the first year we pay 29,831. We also pay interest and principal. So this annual payment, it's towards meeting the principal as well as your interest for this particular year. The interest is always paid on the beginning balance of the loan. So in this case the interest for the year is going to be 15% of the beginning loan of 100,000. So therefore it is going to be 15,000. So out of the annual payment of 29,831, 15,000 is towards interest payment, the balance is towards therefore principal repayment. So principal repayment is nothing but the difference between the annual payment and the interest due for the year, and the remaining balance will therefore be the opening balance of the loan 100,000 minus the principal that we paid during the year 14,831, and this equals 85,169. Now the remaining balance at the end of first year, becomes the opening balance for the second year, and then we continue the entire process like what we did for the first year. So 29831 is the interest, is the annual payment for year 2, and out of which 12,775 is towards interest and 17,056 is towards principal repayment, and the remaining balance is 68,113. And in year 3 the opening balance becomes 68,113, the annual payment is 29831, the interest on the opening balance is 10,217, the principal payment therefore is 19,614, and the remaining balance is 48,499. So like that you can continue to do for all the years. I will skip year 4 and state for year 5. In year 5 the opening balance of the loan will be 25,942, and then we pay 29,831, out of which 3,891 is towards interest payment, and then the principal payment is therefore 25,940, and the remaining balance is close to 0. There may be a small error because of rounding, but otherwise we assume that the loan is completely paid by the end of year 5. So what we have here is a situation, the loan is continuously being paid in 5 years in equal installments, and in each year the payment is towards payment of interest as well as the principal, and we have by constructing this amortization table been able to identify how much interest are we paying every year and how much principal are we paying every year. Now why is this important? Why is it important that we will have to construct this amortization table? Remember when we talked about the ratio analysis, we also looked at, let us say, an interest coverage ratio. Our interest coverage ratio is an important leverage indicator which indicates that what is the margin that the company has in terms of paying the interest. Now if you are able to identify the interest that is being paid in various years, we will be able to also calculate the interest coverage ratios for the different years. So that is very important because lenders constantly monitor, the lenders constantly seek a particular level of interest coverage ratio in different projects. So identifying the interest component in a loan repayment will help us to calculate what will be the interest coverage ratio in various years in the future. Second, we also seen that interest helps us to pay lesser tax because the interest income, the amount that we actually pay as interest qualifies for tax exemption. So when you are actually calculating the profit after tax, it is very important for us to know how much of interest that the company pays so that the tax paid can be calculated accordingly. So therefore for us to also estimate the profit after tax, it is very important for us to identify the interest that we pay for each and every year. So this loan amortization is a good example of where do we actually use time value of money on a regular basis in different projects. Now another example in that we normally encounter is, let us say, what is called as a perpetuity cash flows. What are perpetuity cash flows? Perpetuity cash flows are defined as the cash flows that occur for an indefinite period of time. So if we have cash flows that occur for a very long period, it is very difficult to actually find projects that are going to give benefits for an indefinite period, but if you are able to identify projects which are going to give benefits for a very long period of time, that we can safely assume that to be considered as for an indefinite period of time. Let us say for example today we have concessions given for private airports for as long as 60 years. So 60 years is a fairly long duration. So, projects of this nature or cash flows of this nature can be considered to be as perpetuity cash flows. They may not be actually perpetuity, but they can be approximated as perpetuity cash flows. Now, when we have perpetuity cash flows, what will be the present value of this cash flows? So, we have calculated the present value of a cash flow of A for n periods of time as follows. Now, when you are talking about perpetuity, n is really large, n is really large. So, therefore, this term will be close to 0. If n is really large, the denominator becomes really large and this will become close to 0, and therefore, upon simplification the perpetuity, the present value of a perpetuity therefore simply becomes A by I, that is the annual installment that you get divided by your interest rate. It gives you the present value of a perpetuity cash flow stream. Now, there is a slight modification. You may also come back and tell me that cash flows may not be same if you are really talking about a very long duration. So, cash flows might change from one year to the other or one period to the other, and can we actually calculate a present value of a cash flow stream which changes by a constant amount? For example, if we actually have a perpetuity cash flow stream that grows by x% every period, then what will be the present value of such a stream? So, for a perpetuity cash flow stream that can be approximated to grow at a constant rate for every period, it is nothing but A multiplied by G, which is your growth rate, divided by I minus G. So, this expression gives you the present value of a perpetuity stream which is growing at a constant rate. So, there are many projects where the cash flow stream might grow, and the growth might not be very large, but growth might be very nominal, and in many cases we assume that the growth is almost equal to the rate of inflation in many cases. And when we have this kind of a scenario, we can simply use the present value expression for a growing perpetuity to calculate the sum of all the benefits in present value terms. So, we will end this lecture with this thought question. We have talked about different types of cash flow streams in this lecture. We talked about annuity, and a modification of that annuity is a perpetuity cash flow stream. The question that I have is, can you think of some real life examples which can be considered as perpetuity cash flows? So, think of examples, look for data in various papers or in the internet, and identify some examples which from a calculation perspective can be modeled as a perpetuity cash flow. And in terms of reading material on the time value of money, you can look at chapter 8 in this textbook of Prasanna Chandra. And the next class we will look at additional aspects related to analyzing project viability.